We're going to look at 5 stocks and where to buy them at. Bed Bath & Beyond is going crazy today. It was upwards of 75% today. Big meme stock. People are loving it. It has nothing to do with fundamentals, and we'll take a look at that shortly. First one, AMD. Let's use our software. And again, if you are a member of our software and you're the brilliant person who spends less than a cup of coffee per day to have all the tools you need to be rich, then it's right here. So AMD. So guys, the stock was at a peak of 165 and a low of 73. Now remember, you gotta remember, people were literally telling me how stupid it was to own any other chip company besides AMD. Well, that's the case. Why does it fall? Now you might sit there and say, well, not all stocks go up. Agreed. But why do they go down? My belief is over long periods of time, stocks are a weighing machine, and the short run, stocks are a voting machine. So if you're new to this channel, I'm a value investor. I'm Paul. What I do is I use our 8-pillar process, which you'll see in 2 seconds, and I use that as a quantitative approach to weeding out companies. I want to find the companies that have great numbers. And then from there, I do a little more research to make sure I understand and like the business itself and where it's going. I do believe as a value investor that most everything has a price. And if something's cheap enough, even if it's not a top quality item, you can still make good money on it. So if this makes sense to you and you like this video, subscribe to our channel, like the video, and forward on to somebody else. But let's go check out AMD on the 8 pillars. So I click on our software. We have the 8 pillars tab here. Does all the work for you. 100 times and 132 times earnings and free cash flow. And somebody might sit there and say, Paul, valuations don't matter for companies like this. Yes, they do. Valuations always matter. The only people who say valuations don't matter are the ones who don't understand valuation. And that was me 20 some years ago. And then I saw 2 big bubble bursts and I realized, wait a second, something is missing. These things do matter. And I realized you can buy the best company in the world, but you can overpay for it. And you can buy the crappiest company in the world and underpay for it. Once you realize that, your world will become a lot easier. Your investing life will become a lot easier. Once you embrace that. So in this situation, I believe just based on these 2 metrics that it might be overpriced, but we don't know that for sure because we don't know the future. They've issued a lot of shares, so they're diluting people like crazy. In the last 5 years, they've increased their shares outstanding by 48%, basically 50%. What this means is if the company had 10 shares outstanding before and you owned 1, you own 10% of the business. But now instead of 10 shares, they have 15, but you still own 1 share. So instead of owning 1 out of 10, you own 1 out of 15 shares of the company. Instead of owning 10%, you own 6.6%. You have been diluted. So even if the company got 50% better in revenue, profit, and cash flow, you saw 0 growth. This is the silent killer to investing. Nobody ever pays attention to this, and this is a big one. All right, so let's go to our stock analyzer tool. Stock analyzer tool is the most popular part of our website. It's used to evaluate the company based on earnings and cash flow, profit margin, and multiples to determine what price to pay for a company today, not including the balance sheet. It's a great starting off point. It's a great point to say, should I spend more time in this company or not? I use this for all my screening for all companies. So as we do these other 4 companies after AMD, keep going back and rewatching the stock analyzer because it's so important to understand how you look at the health of a business in terms of the future potential based on your assumptions. So let's first start with revenue growth. So they've done a lot. Their revenue growth has been increasing a lot. In the last 10 years, it did 16.1% a year, 34.8% and 65% last year. That's clearly not going to be sustainable. So let's sit here and do 8, 12, and 16. So I'm still going to match last 10 years for the next 10 years. Profit margin. Now, I do think profit margin will be better than the 6.6% over the last 10 years because they probably had some loss along the way and they weren't as efficient. So I'm going to go with 10, 15, and 20%. Free cash flow margin. I'm going to do same thing, 10, 15, and 20. PE. Now, guys, I'm going to be a little conservative here compared to where they are currently. They're currently at 41 and 42 times PE and free cash flow. The historical average for companies is 15. As the company gets bigger and bigger, it cannot get a higher PE. So I'm going to go with 14, 16, and 18, and 14, 16, and 18. Now for my desired return. Guys, I feel like I was pretty conservative here, but very aggressive here. So I'm going to want to have a higher desired return here and a lower one here. Why is that? The higher my desired return, the lower the stock price will be. I've already been very aggressive over here. So I want to be a little bit higher return because I want a little bit more margin of safety. So I'm going to go with 15, 17 and a half, and 20% desired return. Hit the analyze button. The stock's currently at 100 and I see a low price of 20, a high price of 55 to 60, a middle price of 35. And it does make sense. The stock's currently in 40 something. So paying about half or something like that for a growing company makes sense. All right, stock number 2, Tesla. Oh boy, good old Tesla. Let's go pull up Tesla, the quote unquote non-car company that makes cars. Look at this, 1243 high, 620 low. That's exactly half. I don't know many companies that go up and down in half and 100% all the time, but it seems to happen a lot with this company. Let's go to the 8 pillars tab. You thought 100 times earnings and free cash flow was a lot. 550 and 600 for a company that's worth almost $1 trillion. My guess is this is probably the highest multiples for any company over $500 billion. I don't know that for a fact, but that's pretty ridiculous. In order to justify this, the growth levels have to be insanely high. And we'll see that next in the stock analyzer tool. Not surprisingly, shares outstanding are up a lot. Why? Because the stock is overpriced. So the company would rather issue shares to people than issue debt. So stock analyzer tool, growth level. So let's say in 10 years, they did 1 million cars this year. Let's say in 10 years, they do 5 million. That's an annualized growth rate of 17%. So we'll go 15, 20, and 25%. At 25% growth rate to the 10th power, that takes in about 10 million cars, which is possible, but is it probable? That's what we have to find out. But still, on the high side, it's a possibility they have 10 million cars a year sold. Profit margin. So I'm going to go with 3, 5, and 7. Free cash flow margin, I'm going to do the exact same thing. And then for PE, you're all going to cry about this, but 14, 16, and 18. Guys, the bigger a company is, the lower the PE needs to be. And for anybody who thinks that Tesla's a moat, do they have a great product? Absolutely. Ferrari just announced in this decade, 100% of their cars will be electric. In this decade. So please don't think they're the only electric. Are they the best one? I do believe they're the best electric car maker. Does that mean they deserve a 50 PE? Guys, just math. If you want a higher PE for it, you got to realize that's never ever happened where a company can sustain such a high PE. Even Apple and Microsoft and Google don't have 50 PEs, and they're huge companies with amazing cash flow. And then finally, for our desired return, I'm going to go 15, 17.5, and 20%. Hit the analyze button. The stock is currently at 926. All right. We have a low price of 42, a high price of 160, middle price of 90. So for all you Tesla fanboys out there who think this is crazy, go watch my past videos of the last 2 years where every other hype stock I talked about has fallen by 60, 70, 80, 90% when you guys all said I was crazy. Just go check it out. Is it possible that it's worth $1,000 a share? Sure. But it's just, I hate to say this, I have a hard time believing in the next 10 years that it's going to sustain $1,000 a share. I just have a hard time believing that. I could be wrong. Next stock, Amazon, another expensive stock from valuation perspective, and you'll see that in 2 seconds. It's a $1.5 trillion company. Stock price, high of 188, low of 101. Remember, it had a 20-for-1 stock split. It's raging back, though, at 146. Let's look at the 8 pillars. 100 times earnings, 175 times free cash flow. Remember, guys, they have not made money on their store in a while. They make their money from AWS. I believe they're doing other things in the advertising space on their store platform to make more money. But right now, AWS accounts for all their profit the last time I checked. So let's go to the stock analyzer tool, just like before. So revenue growth. I'm going to do 5, 8, and 11. Profit margin. I'm going to go 4, 4.5, and 5. Free cash flow margin, I'm going to do the exact same thing. So I'm going higher than their recent free cash flow. But for PE, 14, 16, 18. Guys, I'm sorry. As the company gets bigger and bigger and bigger, it's too hard to justify a high PE. It's harder to grow when you're a bigger company. If you don't understand that, I get it. It can be very confusing, but think about it. Is it easier for $1 million company to do 2 million sales or a $500 billion company to do $1 trillion in sales? Just, it's so much easier as you're smaller. The bigger and bigger you grow, you're taking up so much of the world GDP that it's harder to grow and grow and grow. Okay. And finally, for my desired return, I'm doing 12.5% across the board because I can get 9 or 10% from an ETF. Might as well get 12.5 for my margin of safety. 145 is the price, and not a shock there, but look at this. 26, high side 60, low side, middle side 40. The stock's at 150 with a 70 PE. These numbers make sense to me. So I'm actually going to start watching it at $50 a share. So I'm going to change my target to 50 and add it to my watch list. Next stock, Shopify. Shopify has been interesting. Shopify. Oh boy, look at this chart. A high of 176 and a low of 30. Now it's at 40 bucks. Oh boy. That is not good. That is not fun. 2016, boy, that's a low stock price back then. They do $4.8 billion in revenue. One thing I want you guys to see, the price to sales ratio is 10. Apple, Microsoft, Google, they're not even 10. Well, maybe they're 12. But these are very mature companies with very, very stable and growing cash flow. So let's go to the 8 pillars here. I actually thought it was going to be, well, no, of course. Everything is an X except for their revenue, profit, and free cash flow growth. They've issued 40% extra shares. They have a lot of debt compared to their free cash flow. Now, granted, their free cash flow is low probably because they're reinvesting. But the point here is there's a lot of things that have to work through. And before you think that companies are for sure going to make it, go into our software sometime, look at the companies from the last decade that showed massive revenue growth and then stalled out. Your job as an investor is to make sure that you invest in companies based on conservative assumptions. If you do that, you are less likely to make errors of commission. which means make less errors where you're actually buying something that's garbage. You're still gonna have those errors, absolutely, but if you apply the same process to all your stocks you look at, you will buy less stocks, but they'll be better quality stocks. Trust me, it's the way every great value investor, including Warren Buffett, Charlie Munger, Seth Klarman, and Howard Marks, all these guys made their billions and billions of dollars. So let's go to the stock analyzer tool on Shopify. Now, it's still got a lot of revenue growth potential. So let's say 10, 15, and 20% revenue growth. Profit margin, I'm going to go with 10, 15, and 20. Free cash flow, I'm going to do the exact same thing. PE, to 14, 17, and 20. 14, 17, and 20 on the free cash flow multiple. And for desired return, I'm going to do 15, 17.5, and 20%. Because these high assumptions here are probably much less likely. So I want to be more conservative by asking for a higher desired return. Because remember, the higher the return, the less price you have to pay, right? If I pay $1 for something, my return will be X. If I pay $2 for it, my return is going to be a lot lower because I paid more money for it. If I paid 50 cents, it's going to be a lot higher because I paid less money for it. Okay. Stock's currently at $40. All right. Low side, $6. High side with insane assumptions, 23. Middle side is 12 or 13 bucks. So I think Shopify has a lot of potential. Got a lot of growth potential, but again, you can overpay for a good company, and I think that's what's happening with Shopify. Final company, Bed Bath & Beyond. Guys, this is becoming a memer. Look at the stock today, 57% up. It's actually up a lot more than that today. The 52-week high is 30 bucks. 52-week low is $4. It was $4 just a few weeks ago, and now it's suddenly 25 bucks. This is meme stock all over again. And yes, I understand GameStop is still up, and some other stocks are still up, but this is crazy, crazy stuff. But look at GameStop. Actually, look at GameStop. I thought it was up even more than that. It hit a high of $400 and some a share, $300 and some a share in a year and a half ago. Now look at it. Same thing with Bed Bath & Beyond. Don't get sucked in just because you see the stock price going up. It's being pushed artificially by people on the internet, and it has not worked out. Look at GameStop. It's down 90% almost since it hit its high. Be very cautious about these. If the things I'm saying to you make sense, please subscribe to the channel and watch our next video where we go through a more in-depth talk about how you look at the 8 pillars next. Thank you very much for your time.